What I'm going to talk about today is the commodity cycle. And I'm going to talk about why the commodity cycle happens like it does. Now, what's really interesting is that this century, we've been through two of the biggest commodity booms that Australia has experienced since 1850. And it rates with the two previous big booms. One was as a result of the gold rush in the 1850s. Between 1850 and 1875, Australia grew very, very rapidly. By 1885, Melbourne was the second largest city in the British Empire after London. And Australia and Argentina, amusingly enough, had the highest per capita GDP in the world. It wasn't until after World War II that there was another commodities boom of that size, and that was in the 1940s and the 1950s, and that obviously was because of the rebuilding from World War II. And a lot of demand came because a lot of the places in Eastern Europe, which produced a whole lot of metals, but also a whole lot of wheat and other things like that, had been occupied by the Russians as a result of World War II. That generated a shortage of all those things and a boom for us in places like Canada. But this is different because in a very short period of time, over the last 20 years, we've had two commodity booms, and the most recent commodity boom was, according to the Reserve Bank, even higher than the commodity boom, the previous highest commodity boom, which was after the gold rush. Now, why did that happen? And I'm going to talk about two causes of that cycle, and then I'm going to show a little bit about a few individual commodities. So there are two things that drive this, and the big ones this century have been variations in the US budget deficit. Think of it this way. If the US budget deficit goes from about 2% of GDP to about 12.5% of GDP, as it did in 2009, this generates an enormous expansion of US demand for goods. This is then imported from, guess where? China. And China has a manufacturing boom, and they import the resources to make all those things and the power to run the factories from us and people like us. So that's how the circle works, and that's how it worked in the period after 2009, because the average budget deficit in the US since the 1920s is about 3% of GDP, but in 2009 that went up to 12% of GDP, and that was the enormous expansion of demand. That then cooled because the budget deficit went back to normal. And then what we had was the pandemic, and in the pandemic, the US budget deficit expanded even to a greater degree than it did after the financial crisis. And that generated an even bigger boom in the demand for import products in the United States, and that generated an even bigger manufacturing boom in China. Remember how China was running out of electric power during that period? And that generated enormous demand for the sort of things, energy and metals that we sell. And that's the simple explanation. And that's pretty much what happened. Now, what I'm going to tell you now is, I'm not going to give you good news. I'm going to say that right now, this market in commodity prices is as bad as it should be, because the US budget deficit has declined from 15% to 16% of GDP to only 3% of GDP 2 years ago, because this effect of the US budget deficit works with a lag. Okay, so right now, commodity prices, in terms of our model, look at the red line in the model, are as bad, have fallen to a dramatic low after the previous boom. But what you'll see from the recovery in the red line, next year and for continuing years after that, we expect them to rise. Why do we expect them to rise? It's the US budget deficit, because the US budget deficit 2 years ago was 3% of GDP. Now it's expanded to a bit over 7% of GDP. And that increase in 7% of GDP will be continued pretty much to the end of the decade. Why is it? Well, because President Joe Biden, you know, that wonderful old man that everybody believes in and trusts, remember him? So that guy, he had the CHIPS Act, enormous expansion of domestic production and manufacturing of chips, and write-offs on that. The amazingly called Inflation Reduction Act, which has almost nothing to do with reducing inflation, but is a subsidy, provides subsidy for manufacturing of things like electric vehicles in union facilities. And there's other expansive projects like that which result from the COVID period. So what you've got is, from this low, what you have is a recovery between now and the end of next year, and then commodity prices remain at pretty reasonable levels going forward. It's interesting, this just should briefly look at the US, the outlook for the world economy. What you can see there is the US economy has been pretty strong, gets a little bit weaker next year. Europe has been pretty weak, gets a bit stronger next year. So what you've got here is no world recession. Every country is growing at a little bit slightly different, and Australia growth is expected to pick up to from about 1.5% now to about 2.3% next year. So all of them are out of cycle and there's no world recession. And that really what supports this recovery in commodity prices, which is going to happen from now on. The other thing that's interesting to look at is the level of international reserves in the international monetary system. Now, this is the amount of reserves, foreign reserves, that are held by all of the central banks which are members of the International Monetary Fund. And what we see is in 22-23, we had a slump, just like the slump I was talking about before, as a result of the US budget deficit. And the actual year-on-year rate of growth of that, that number, was the lowest since the 1980s. That's why inflation is coming down. But we've also had a slump in world trade, and you can see that when you hear about China, you know, having difficulty with their economy exporting enough stuff. Okay, this is the US budget deficit that I talked about. So that's the stimulus upside down. So the big deficit in 2020, the biggest since World War II, that's what generated the big boom in commodities. Since then, between 20 and then in 2022, what we had is it bounced back to a deficit of only 3%. That's what generates the slump in commodity prices now. And from then on, what we see, it expands again to about 8% of GDP. That's what generates the recovery from now on. Individual commodities, I'll just touch on a few individual commodities as we go through. Iron ore, what's driving that, and metallurgical coal. Shortly, you'll have a presentation about metallurgical coal from one of the firms. And that's really the level of, driven by the level of Chinese steel production. You can see that Chinese steel production peaked back in 2020 and has been going sideways ever since. But that's still a huge level of demand. They generate more than half of the world's steel, and therefore half of the world's demand for metallurgical coal and iron ore. But that sort of has stabilized. It's not going to hell. It's just stabilized at a very, very high level. Okay. Let's try and get forward to, we've got a commodity. We do have a commodity model of the iron ore price, which says it should be about $120 a tonne. Let's go forward to oil. Now, the two things that drive oil are the level of stocks. This is the level of stocks in the US system, and also the level of the US dollar. How about that for a simple model? The lower the stocks, the higher the price. The lower the US dollar, the higher the price. So stocks have been going pretty much sideways this year, and that's the inverse relationship with the US dollar there. And it gives us an equilibrium price of, about $86 a barrel, which is kind of where it's been kicking around in terms of the Brent oil price, and $80 a barrel for West Texas. The real price, the average real price when deflated by the US CPI for oil is about $86 a barrel, which is around about where it is, okay? So we're pretty much at the long-term equilibrium point for oil. This is a study that I do every quarter about the International Energy Agency and its demands, its estimate for supply and demand for oil. what it shows is that there should be a little bit of a tightening between now and the end of the year, which brings down stocks a bit. But it's modest. There's no big boom there, but it's a steadying of the price, and that's what you're seeing with all these models show that the oil price steadying about $85. LNG price really interesting, a model of that, and what it shows is a combination. The gas price is kind of like is what's left over. Think of this as an electricity generating model, that if energy is provided from coal and energy is provided from oil, they still burn oil in the Middle East to generate electricity. We burn coal here and in China to generate electricity. But the thing that keeps the balance of supply is LNG or natural gas. And so the LNG price is actually driven by this interaction of oil and coal. And right now it should be a bit higher than it is. And it looks like it's getting a bit stronger in the market. Metals, copper, there's been a big lift, a short-term lift in copper stocks in China. I think this is just strategic forward buying by the Chinese. The problem is it's not driven by fundamental demand yet. Okay, now we all know that the demand for copper is going to be absolutely enormous out to 2040 and out to 2050. The international agency has talked about millions of kilometres of electric power transmission that has to be built by that period, which generates increase in demand for copper. In the long term, incredibly powerful, but right now the model says the copper price is a bit overbought, and it'll come down before it goes up. Long-term demand is very strong, of course. Nickel stocks are just off their lows for the period of this century in terms of stocks, and we think our model tells the nickel price is around about fair value. Zinc stocks, the demand for zinc really is for coating of structural steel, so that as there's more, as China makes more and more steel, there'll be demand for more and more zinc to production to covering it. And that's a pretty reasonable model, and it tells us the zinc is just a touch overvalued, not much. Lead is a little bit overvalued in terms of our model for that. Gold price. This is our model of the gold price. It explains 68 monthly variation since the 1970s. It's the only statistical model like this of the gold price I've ever seen. If somebody sees another statistical model of the gold price, please send it to me. I'm interested in it. Now, what drives this is that US budget deficit that we were talking about. Bigger US budget deficit, higher gold price. And the other things are, of course, as everybody knows, inflation. Not just inflation, but also the level of prices. So what we've had is an increase in the level of prices, and this has generated a recovery in the gold price. But right now, it's a little bit overbought. Silver price is around about exactly fair value. Currencies, those who are interested in the Aussie dollar, our simulation has the US dollar being weaker, of course, over the next year, because we think that the Federal Reserve, I promised I wouldn't talk about the Federal Reserve, because the Federal Reserve is going to cut rates over the next year. And as that happens, the US dollar goes down and the Aussie dollar goes up, because we're not going to start cutting until the middle of next year. Gee, I promised I wouldn't talk about that either. But you'll learn more about those things by watching Michael Knox Morgan's YouTube. So we see the Aussie dollar going up a little bit. And what are we going to talk about here? Oh yeah, remember that story about how China has all of this US debt, and if they decide one afternoon they're going to sell all the US debt, then it'll destroy the US Treasury market. Turns out that they already did sell half of all of the debt they have, and they've been doing that over the last 10 years. And as a result of that, it's been bought basically by the Europeans and a whole lot of tax havens, international tax havens. So anyway, the British have bought a lot, the British banks hold a lot. Belgium and Luxembourg, which have representatives for Swiss banks and German banks and such. They hold a lot, and a whole lot of others. And in terms of the stock market, hey, the stock market's going up. And the stock market is going up because US earnings are going up. This is earnings per share, operating earnings per share of companies in the US stock market. And they're going up. Well, remember, everybody said that there was going to be a recession and the stock market was going to go to hell. But instead, the reason there wasn't a recession is because of that budget deficit, that stimulus. That's what's driving the strong growth, and that's what's driving these strong profits. And that's what's driving the US stock market to go up. As we can see on a 12-month rolling basis, it looks even stronger. So that's why you've got this drive here. All of those things, and our stock market models, of course, say that the stock market is a little bit overbought, but not much in the US. There is seasonality as the stock market chart. You'll know right now that the stock market's been very strong in July. And the reason the stock market is very strong in July, because, hey, it's usually strong in July. On average, over the last 10 years, July is the strongest month. So it's very, very strong. But what we're going to get, what you're going to get in September is you're going to get the end of the US tax year when companies are paying taxes. And therefore, because that corporate money is paying taxes, the stock market on average goes down. And that's interesting because what also happens, as we know, we are in a presidential cycle. And in that presidential cycle, usually people stay out of the market for the 2 months before the presidential election, and whoever wins, they get back in afterwards. And you'll see this just as a normal seasonal rally. Should have a big kick in stocks before you get into, as you get towards the end of the year, when people are celebrating whoever won, and the stock market goes up to take us to another successful year in equities. I finished a minute early. Isn't that amazing? And remember, as I said, if you want to know my views about other things, Google me, Michael Knox, Morgans, YouTube, and every week I give a talk like this to clients of Morgans, but you can watch it at home on YouTube.